One of the things you always need to do is to keep learning. Benjamin Franklin said most men die at 25. They just wait for their bodies to catch up. What he really meant by that is that when it comes to our hobbies and it comes to the work that we do, we continue to learn. Other than that, most of our political, religious, even financial decisions have already been made. Now, the interesting part is financially, everybody's concerned with their money, but it doesn't necessarily mean they have the training to be able to make all of the decisions. Oh, yes, you care about your money. We understand that. But how do you think about it? What is the process? We're going to take you through that on Consider This Program today. Well, good morning and welcome to Consider This Program. I'm your host, Joe Clark.
And I'm Darren Hardesty.
Happy to have you along. Darren is one of our senior advisors at the Financial Enhancement Group, and I just could not be more proud. Every meeting that I have, Darren is part of. So when Joe's not here or Joe's not present, Mr. Hardesty steps up, takes the reins, and does a phenomenal job. So we are going to talk about what I named the Fiduciary Focus years and years ago. I believe as you go through your financial life, you need to be thinking with a process as opposed to arbitrary news stories, right? So the Fiduciary Focus is broken into 4 areas. I'm going to let Darren walk you through those, and then I will fill in as we go. So, Darren, you have the comm.
Well, thank you very much, Joe, and the compliments are always nice. So, our focus, since we're looking at habits and making sure that we're learning and, what we need to really focus on in the new year, our Fiduciary Focus can kind of take a different spin because I know we go over it a lot, but I'm going to really make sure that we're focusing a little bit more on the learning side of it, as you mentioned in the intro. So if you don't have a fiduciary, you are your own fiduciary. If you don't hire somebody like us to work for you, you have to make decisions financially, and you're the one that's in charge of that. The problem is most people, like you said, they learn about their hobbies, the things that they're interested in, but not everybody is interested in personal finance or the financial industry. And so they come into our office and they've done a great job. They know the general principles of saving, making sure that their money is in different places for the most part, but then they come in and they don't know the real details, the master's level stuff about finance that we get to do just because this is our career and what we've chosen to focus on. So the first of the 4 is risk and volatility, and making sure that you're constantly learning about what's happening with risk and volatility in the market. And I think everybody can agree for different reasons, the market and economy that it was 25 plus years ago, even 10, maybe even 5 years ago, is not the same as what it is now. And so the rules that you learned when you started your career of investing and putting money in and what you should invest in and how much equity versus how much bond exposure you might want to be in, all those rules may or may not have changed. So it's important that you're constantly paying attention to the risk that is now in play, the different volatility aspects of what you're invested in, how much something's willing to go up or down, making sure that you know those new rules so that you can adjust your portfolio in a way that's going to keep up with those new rules in a better fashion.
I don't even know if you can use the word rules, though. You can certainly use trends.
Sure.
Right? And that's one of the interesting things. So when you talk about risk is not getting your money back. Mm-hmm. Volatility is merely not being able to have the price that you want at a particular time. It's just the market going up and down, right? And
right.
So the trend we've seen, and we've talked about this at the Thirdly, that's a meeting that we have with our families where we sit down twice a year. It used to be 3 times a year, hence the word Thirdly. Now we do the market carver every week, and we don't need to do it 3 times a year. But we bring people in, buy dinner, and we sit down and we have these conversations. But when you look at the Great Depression, it took 14, 15 years for the market to get back to its previous high, right? And you go to the 70s, and it took 8 or 9 years, and then the crash in 87, and the tech wreck in 2000, and the 08 and 09 crisis, and then now we're here in the pandemic in 2020, and what you've seen is that market, that volatility has fixed itself, if you will. The market's got back to a new high in a shorter term period of time. Now that doesn't make it a rule. But it certainly makes it a trend that we've been able to see this going through. And I've got certain beliefs about why that is. We've talked about that in the meeting with our families, but I mean that is the reality. And so when you look at a market over the last 80 years and you try to say, okay, how do I think about risk and volatility over 80 years, is probably different than how you need to think about it where we are today.
Oh yeah, absolutely. It's like you said, there's multiple reasons for why the market corrects faster if there is a correction, if it bounces back. You look back to just recently last year, March of 2020, you think where we were and how it felt day to day in March of 2020 versus December of 2020. It's just incredible the speed at which everything moves now. So if you're operating under rules where, hey, it's going to take a good 5-10 years for this to all come back. I don't want my money in something that's going to take that long to come back. It's just not the same. We're not playing by the same trends and rules. I'll put in air quotes for you, but it's just a different time. So having somebody on your side is really important to make sure that you are keeping up, because there's so much information. There's so many different things that are happening quickly. Having a professional that can give you advice and counsel you through these things, it's really important.
Got it.
So the next is our fees and expenses. And fees and expenses, this is something that everybody generally wants to know about. How much does it cost to work with a financial enhancement group? How do you charge, for your services, those types of things. And what I really want to focus more is not just that, because, that's one aspect, but how you invest in the fees and expenses in what you invest is what's really changing now. It's different than what it used to be. Mutual funds are obviously a very popular item for somebody to invest in, or an asset to invest in. It's in most 401k plans, and they made a lot of sense when they first started. And for many years, and as you've put, until we created Excel, a modern spreadsheet that can track data, mutual funds made a lot of sense. But now we have so much information, and we have so much that we can do that's more efficient through, for example, exchange traded funds. There's really no need for a lot of people to invest in a mutual fund versus an exchange traded fund. And that's something that we educate our families on a regular basis. They've never really heard of exchange traded funds, but when they see it all laid out, they wonder, well, why haven't I learned this before?
When it looks like it works, nobody asks what's wrong.
Right.
And that's the bottom line. And so you go through 3 phases of finance: accumulation, preservation, and eventually distribution, whether you like it or not, or the IRS makes you do that. And when you've got money in a 401k that suddenly is $1 million or $1.8 million, or approaching $2 million because you've been putting money in a consistent basis and it's going into mutual funds, you kind of shrug your shoulders and go, Joe, what can be the problem, right? What can possibly be wrong? Well, we're looking for anything that when we manage money inside of a 401k or inside of IRAs, we're looking for anything that slows down your ability to be able to grow, right? So anything that constricts returns, which would be fees and expenses. And then the second thing we want to do is eliminate risk, in terms of that. So if we can move people out of things that are high cost, where there's a lot of expenses and things that are going on, put them in an area that has less fees and expenses, thereby increasing their return by reducing their charges and simultaneously reducing their risk, then it's just a win-win for everybody.
Yeah, and we manage a large amount of money for our families, and every basis point or every small percentage that we can save for our families is very important. And when you have money inside of a mutual fund, you're essentially paying a small fee to a fund manager. And the way that we've structured...
Not small, don't say that.
Yes, you're exactly a fee to a manager. And so it really makes it difficult for us to justify why we would pay, since we have portfolio managers on the team, why pay another portfolio manager to do something that we are already doing on our own. And I think more and more as the market evolves and as RIAs become more adept at making sure that we can do different types of investments, different ways that we can do this for our families, mutual funds are going to have to make an adjustment to keep up with the more efficient market that's coming around.
And they're trying. I mean,
Right.
let's be fair. They're trying. Here's how they're trying. They're the largest owner of exchange-traded funds on the planet.
Yep.
So let me just say that. And if you're driving, please don't wreck. Inside of your 401k, if you own a mutual fund, the probability is that mutual fund has bought exchange-traded funds, again, with much smaller, but still fees and expenses that are inside of them because of the efficiency that are there. When I started in the industry back in 1987, it was $300 to make a stock trade. So if you were going to sell $10,000 worth of stock, you were going to pay a brokerage firm $300. Today, as of the time of this recording, we've got more than $650 million we manage. And, our agreement, our cost of trading is zero. And, so you just don't have those challenges anymore. We can buy and sell without any implications in terms of cost or fees or expenses that take part in your portfolio. So we're able to reposition, not by a calendar, not on a quarterly basis. We don't try to time the market, but we're able to look at it and use good fashion reason that says, hey, here's where we are. My job as the managing partner is to take care of the narrative, the big picture. So you're always going to hear me talk about demographics, tax codes, what's going on in the world. Adam is a chartered financial analyst. He's our CFA, our chief investment officer. His job is to look at it from a fundamental perspective to say, okay, here's where we are. And then Andrew Thrasher is a chartered market technician. He looks at the technicals of what's going on inside of the market, comparing apples to apples, as opposed to worrying about what the company does. He's just looking at it from a technical side to see relatively who's performing. That's how the portfolios are built. But when you come in and you get signed up for a Next Steps meeting, you're going to meet with Darren or Grant or Aaron, or Jamie or Dean, and you're going to sit down and they're going to have a conversation looking at your stuff, particularly your tax return, your legacy plan, and give you things that you need to consider today, things you're going to want to consider in the future. And if we choose to partner together, what FEG will do for you. Go to yourlifeafterwork.com. Get signed up for a Next Steps meeting.